What's been interesting over the past 36 months, as we all know, interest rates have gone up at a historic pace. So what that did to the housing market was it really didn't, at least until the last 6 to 8 months, it really hadn't had an impact on pricing from a negative standpoint. What it did do is drastically lower the amount of folks selling homes, and it lowered the volume. And we're going to talk about that some kind of as we move forward. Our current view and consensus view is, despite the fact that rates have been higher for so much longer than anticipated, that we think there will still be positive home price appreciation nationally this year. We think there are going to be pockets where home prices will go down, and we'll talk about that. And we also think rents will continue to grow. Part of that rent growth is going to be supported by the fact that right now it's about 44% cheaper to rent a starter home than it is to buy a comparable property. So that is supporting rent growth. People are kind of staying in place. And we're also seeing that in higher retention rates. So for a lot of the publicly traded institutions, but also just single family in general, there are retention and renewal rates in the 70s and 80%, which is relatively historically high compared to what you've seen historically. So we think that's driven by the fact that people aren't ready to start buying, and we'll talk about where we think interest rates are going.